Ladies, gentlemen, and savvy investors of all stripes, gather around as I unveil the distilled wisdom of a Wall Street legend, none other than Peter Lynch. Today, we venture into the financial jungle with his classic Beating the Street in hand, ready to extract its top 10 insights. But fear not, for our journey shall be one of both profit and pleasure, peppered with wit sharper than the corners on a bar chart and more engaging than the closing bell on an all-time market high. First, a necessary disclaimer. I'm not your financial advisor, and my reading of Beating the Street doesn't come with a complimentary broker. So let's roll up our sleeves and get to the heart of Lynch's investment wisdom without risking a single penny. 1. Invest in what you know. Our odyssey begins with Lynch's now infamous mantra, invest in what you know. You see, Lynch argued that the best stock picks aren't found with complex algorithms or seances with Wall Street wizards. They're right beneath your nose, like the fastest moving line at your local sandwich shop, or the brand of shoes repeatedly scuffed by your enthusiastic child. Lynch didn't just believe in studying balance sheets, he believed in a good old fashioned, boots on the ground approach to investing. He encouraged investors to apply their everyday experiences when evaluating potential stocks. So next time you enjoy a latte, take a moment to ponder if that coffee chain's stock might be as satisfying as its beverages. 2. The PEG ratio, Lynch's North Star. When wandering through the forest of finance, Lynch adopted the price-earnings-to-growth ratio as his guiding star. The PEG ratio aids investors in determining the relative value of a stock by comparing its PE ratio to its earnings growth rate. In essence, if a stock's PEG ratio is less than 1, it could be the Wall Street equivalent of a buy one, get one free sale. Lynch believed that a company growing at 25% should have a PE ratio of 25, and if it's lower, that stock might just be a bargain bin gem waiting to shine. 3. Small companies, big dreams. Lynch didn't shy away from the Davids in a world of Goliaths. He was convinced that small, lesser-known companies often present the grandest opportunities. These hidden champions tend to be underfollowed and overlooked by analysts, which means their stock prices might not reflect their full money-making potential. He affectionately dubbed these intriguing investments multi-baggers because they had the potential to double, triple, or even quadruple in value. Embarking on a treasure hunt for the next multi-bagger is not just about finding an untouched stock. It's about uncovering the Cinderella story before the clock strikes midnight and Wall Street's attention turns its stock into a golden carriage. 4. The importance of homework. Mr. Lynch did not advocate for freewheeling stock purchasing. No, he championed the idea of doing one's homework. This is the not-so-secret recipe. For every hour you might spend watching a stock market channel, spend 5 delving into financial statements, reading quarterly reports, and learning about management teams. According to Lynch, if you're not willing to dig through a company's past, you're practically investing with a blindfold on. So arm yourself with knowledge, lest you find yourself in a financial horror story where you're the one who's always left in the dark. 5. Stalwarts. Boring can be beautiful. Peter Lynch loved the stalwarts, large, dependable companies that have weathered the storms. In his book, he reminds us that investing doesn't always have to be about seeking the next shiny technology play or hot stock tip. Sometimes, true beauty lies in the mundane, those reliable companies that manufacture the screws and bolts that hold the world together. These might not be the talk of the town at swanky cocktail parties, but their consistent earnings growth can be as delightful as a surprise dividend check. 6. Turnarounds, not just for bad movies. Now let's talk about the turnaround companies. These firms have gone off track and are in need of some corporate compass recalibration. Lynch knows they're risky, often fraught with as much danger as a tightrope walker's netless finale. However, he also believes that turnarounds offer generous rewards for those willing to bet on a company's resurgence. They're the blockbusters of the investing world. Sometimes you get a dud, but occasionally you strike box office gold. Remember, some of the best stories are comeback stories, if you're patient enough to stick around for the final act. 7. The 6-month checkup. If an investor's portfolio were a patient, Lynch would be its diligent doctor, recommending a thorough checkup every 6 months. He urges you to reevaluate each of your holdings semi-annually, asking the vital question, if I didn't own this stock now, would I buy it today? If the answer is no, it might be time to give it the old Yeller treatment and put it out of its misery. Portfolio management isn't about nostalgia. It's about economic survival of the fittest. 8. Declining industries. Beware the value trap. Peter Lynch warns against the siren call of a declining industry. These may appear as value investments with low PE ratios that whisper sweet nothings to bargain hunters. Yet Lynch cautions that these industries often face insurmountable headwinds. Investing in them can be like catching a falling knife. It might look cool in a movie, but in reality, you're more likely to end up with a fiscal boo-boo. It's better to focus on industries with a tailwind so strong they could propel a 747 to new altitudes. 9. The long view, a marathon, not a sprint. According to Lynch, Rome wasn't built on day trades. The legend of investing reminds us that, like a fine wine or an artisanal cheese, a good stock often needs time to mature. His horizon stretched beyond the next earnings report. He encouraged investors to think in terms of years, not minutes. By taking the long view, you're less likely to be shaken out by the market's daily noise and more likely to hold on for those sweet capital gains. 10. You can't predict the market, but you can prepare. Lastly, Lynch rebuffs the mistaken notion that investors can predict market swings. He likens market predictions to astrology, entertaining at parties, but not a basis for decision-making. However, you can practice prudent risk management by diversifying your portfolio, keeping some powder dry, cash reserves, and maintaining a steady course. Just as a seasoned sailor can't predict the waves but can ready the sails, a savvy investor won't try to time the market, but will be prepared to adjust their holdings when the economic winds shift. And with that final insight, we draw our exploration of beating the street to a close. We have ventured into the heart of a financial masterpiece and emerged with Lynch's golden nuggets of wisdom tucked safely in our analytical toolbox. Remember, these insights are but signposts on your own investing journey, a journey that requires both courage and caution, peppered with a healthy dose of humility. Peter Lynch's stock-picking prowess remains as relevant as ever in a world where the only constant is change. So embrace these lessons, for they are more than mere words on paper. They are the very torchlight that can illuminate your path to financial nirvana, or at least keep you from stumbling into a fiscal pitfall.